Well, I always tell young people that are interested in our business that if you really love to learn, there are few jobs I can think of that are better than the equity analyst or fixed income analyst role, because you are essentially an eternal student. And the beauty is you're also producing something that is having a really positive impact on millions of people.
So you're a CEO expert. Why to you is that so important?
I realized that the evaluation of a CEO is really an important critical ingredient to what we do as investors.
Would you own a company where you didn't love the CEO, or if you didn't trust the leadership?
I wouldn't own it.
So for you, in your concentrated portfolio, is that 30 stocks, 100 stocks?
So I try to hold 20 stocks or less across each of my responsibilities. And the reason is...
Today, we have Martin Jacobs with us. Martin Jacobs is a portfolio manager based in Los Angeles, down the hall from me. He's been at Capital Group for 23 years. And welcome, Martin.
Thank you, Mike.
So we are supposed to be talking about investing, but I can't help myself. That is not where we're going to start today, Martin. You lived in Chicago for about a decade before you moved to LA. And if you have a goat story, we're going to hear it. And I'm not talking about the animal. I'm talking of the greatest of all time. So tell us a little bit about your Michael Jordan story. I will get into the investing, I promise. But if you have a Jordan story, we want to hear it.
All right. Well, great. Well, it's a fun story, Mike. You know, as you said, I did live in Chicago for 10 years in the 90s. I was there for the 6th championship run for the Bulls. I was a big basketball fan, went to a lot of the games, and really loved my time in Chicago. But I did play pickup basketball at a gym downtown. And for those people that followed Michael Jordan's career pretty closely, they know that there was this period where he quit basketball.
Yeah.
His dad passed away. He basically took some time off.
But he played baseball for a little while during that time.
That's right.
Yeah.
He went and played baseball. And then fortunately, he quit baseball and came back and won another 3 championships with the Bulls. But in that little window there, he used to actually come over to our gym and play pickup basketball. It was actually, I think, something that was written into his contract that he could play pickup basketball because he liked to do that. So the first time I was on the court with him, I was on the opposing team. He came down the lane and I cut him off and he slipped and he fell like really hard. And I asked him if he was okay. He said, I'm fine. So I didn't think anything of it. Couple plays later, I'm running down court, and somebody sneaks up behind me and delivers a huge elbow right to my chest. As I'm sitting there, like trying to regain my breath, I look up and it's him. And so the next time I get the ball, he's moving people out of the way to guard me. And so it's pretty clear now that he has a personal vendetta.
He's got a thing against Martin Jacobs.
Exactly.
Okay.
So like any self-respecting amateur hack out there, I quickly pass the ball away to somebody else. And so, needless to say, my offensive production that game was pretty low. But I did actually have an open layup to the hoop. And as I extended my arm and was about to deliver the ball to the basket, it was almost like a magic trick. I looked up, the ball was in my hand, and then the next second it was gone.
Right.
And so I quickly realized it was Michael with those long arms behind me. He probably flicked the ball away.
He was waiting all day for that.
Right. Like it was an acorn or something. I think he said something like, not today, son.
Right.
So amazingly, despite all that, we actually won the game. Our team won the game. And because it's Michael Jordan, they just go new 4 for Michael. And so we got to play again. And, I'd see him around the gym. He actually paid me a nice compliment. He said, oh, you have a nice jump shot. But, it was just a fun time to be in Chicago. And I was a big Bulls fan. And to have had the opportunity to play on the same court with arguably the greatest basketball player that ever played was quite a great experience.
That's a fun story. I am sure other people have their own GOAT for basketball. He's mine, so I appreciate this story. All right, let's get into investing in Capital Group. You joined here in 2001. And you were a lateral hire. You didn't come up through our Capital Associates program. You didn't come through the MBA program. You were a lateral hire. Tell us about joining CG in that way.
Yeah, so I was 13 years in the industry. I was an analyst in New York at a firm for 3 years, 10 years at Brinson Partners in Chicago. And I went through the regular gauntlet of 25 plus interviews. So when I joined Capital, Capital knew me pretty well, and I knew Capital pretty well, but there were still a lot of surprises. When I grew up in the investment business, I'd spend an hour going over an investment recommendation with the research director, the head of the equity group. They would go into great detail about my investment thesis, the research process, my financial model. And I showed up to the first investment call at Capital Group, and they literally went through about 10 investment recommendations in an hour. So I quickly realized, because of the scope of what we do, all of the different funds, the different portfolio managers, the different styles, that there's a real priority placed on brevity, the ability of our analysts to succinctly communicate their investment thesis and other considerations that portfolio managers needed to understand. And so that, for me, took a lot of learning
Taking that
and some
hour
changes.
and
That's right.
condensing it. Yep.
Yeah. And the important thing, there's no less work, no less intensity of the work, but the communication piece had to be much more efficient because of the manner in which we manage money.
Yeah, now a lateral hire for us is not so unique. When you did this 20-something years ago, it was, but now we've really figured out how to do that in a better way. You were an analyst for a really long time before you became a portfolio manager, which is part of our secret sauce, in that we allow that and encourage that for as long as the individual wants. So the way in which Martin Romo, who's our chair and CIO, describes you, was an expert in industrials. I'm embarrassing you, I'm sure, but he says Martin was the foremost expert in industrials before becoming a diversified portfolio manager. So why so long? I'm sure you had an opportunity to transition earlier into diversified portfolio manager, but you talk about loving being an analyst. That's the best job. So
Yeah.
talk about that, if you will.
Yeah. Well, I always tell young people that are interested in our business that if you really love to learn, there are few jobs I can think of that are better than the equity analyst or fixed income analyst role, because you are essentially an eternal student. And the beauty is, as much as you are an eternal student, you're also producing something that is having a really positive impact and a meaningful impact on millions of people. And so if you kind of think about it, when you're back in business school, you're taking economics, accounting, finance, corporate finance, maybe you might take a psychology class. All of those things play into the toolkit that you utilize as you build your mosaic around a particular investment thesis. And so that's what makes the job so much fun. It's always something new. It's always something different. And so for me, that's why I really enjoyed being an analyst as long as I did. And the beauty of our operation is that there's not really a hierarchy. You know,
Right.
we have specialist investors, we have general investors. And so when I made the transition from specialist investor to generalist investor, I was really drawing upon a lot of the same techniques, a lot of the same tools. And that's, I think, served me pretty well.
So you've said, though, that being an analyst was the most fun in terms of a role you've ever had. Is the portfolio manager job less fun? How would you describe that?
I think it's as fun for this stage of my life is the way I would describe it, because the thing about the analyst role is that it's relentless.
Right.
You are on 24/7 earnings calls, updating models, out kicking the tires. It's just nonstop. And it's a lot of fun. Don't get me wrong. It's intellectually gratifying and challenging. But as you move into your 50s and your 60s, it's a lot to ask of a person.
Right.
And so for me, the portfolio manager role is equally as fun, but it doesn't have the same level of physical demands, let's just say. And so I feel like I can still bring all of that history to the table in the role, but at the same time, I'm not, out there kicking tires on the job, 24/7 in the same relentless manner that I had
That
to when I
makes
was an
sense.
analyst.
So you're a CEO expert in that you believe, and you've done a report recently. I sat in on one of the meetings where you shared it with the investment group, where you talked about the importance of leadership, the importance of CEOs. You know a lot of the CEOs exceptionally well in our business. Why to you is that so important?
Yeah, well, it's a great question. And let me explain it in two parts. So the first part is kind of what I was trying to do. And so I realized that the evaluation of a CEO is really an important critical ingredient to what we do as investors. And so I went back and looked at my time as an analyst to try to identify the attributes that were consistent with really excellent CEOs. And so I looked at basically 25 plus years of my experience following industrial manufacturing companies, hugely rich data set. And the criteria was, is this somebody that I knew pretty well? And is this somebody that also produced superior shareholder returns? And out of that work, I found 9 individuals, which is a statement in and of itself, right?
That's not a huge number.
That's not a huge number. And it just speaks to how exceptional it is to find somebody that is a really strong CEO, because it's almost every week you look up and somebody's been fired after a year in the job or 2 years in the job. On average, each of these individuals was in the job for 13 years, which is quite rare. Because
in the job at that company.
In the job at that company as CEO. And so as a result, like if you look at the average for a public company CEO, it's only about 5 years. And so that's a statement in and of itself. But they were very different people. Some were young, some were old. Educationally, they had very different backgrounds. So we had, on the young end, I identified a gentleman by the name of Adam Norwitt. He's the CEO of Amphenol, still CEO there today. Larry Culp, in his first CEO role, was in his late 30s when he took the role at Danaher. And then at the other end, I identified a gentleman by the name of Ken Iverson. He was 60 years old when he took the role at Nucor, which was a maverick mini mill company that completely disrupted the steel industry. And then in terms of backgrounds, you had some people that were scientists, you had 2 lawyers in the bunch, you had a guy that was a failed fisherman. So it was a pretty eclectic
Wait, who
group.
was the failed fisherman? I got to ask that.
Yeah, that was Dave Cote, who was the CEO for Honeywell for many years, incredibly successful CEO. And so that was kind of fascinating. And then beyond that, despite the differences, they all generated spectacular returns, on average about 22% per annum for this group during their tenure, which is roughly 2.5x what the S&P 500 did over the same time frame. So there were about 4 or 5 things that I recognized that were consistent across most of the individuals. And the first was that they were good operators. And as you know, Mike, as a CEO, you need to be a good operator in order to be a good coach. You need to be a good player generally, because you are more of a player coach. And so that seemed to be something that was consistent across the whole group. The second item is, I would say, they were good capital allocators. So they thought more like you and I do about investment decisions. This is a good acquisition. This is a bad acquisition. This is a good divestiture. This is a good use of capital in terms of buybacks or dividends. They thought very thoughtfully about those types of things. The example that I highlighted in the piece was, I talked about a guy named Nick Jabria. Nick was the CEO of General Dynamics back in the 90s, and he made this hugely controversial acquisition. He bought Gulfstream, which of course is the business jet company, and GD was a defense manufacturer, and that raised a lot of questions. And then also at the time, business jets were not highly thought of. It was kind of the domain of wildcatters and rock stars and things like that. But Nick saw this as being a more normalized, stable business with an increasing presence in the corporate fleet market. Turned out to be a huge home run.
That was good capital allocation.
Good capital allocation. And there's lots of other examples by these individuals on good capital allocation. So that was another important quality of a lot of these folks. The third thing I would say is more of an intangible, but it's really the ability to inspire others, particularly large groups of others. And this is this notion of, you're not necessarily the most charismatic person in the world, but you can set forth a clear mission and a set of priorities, and people will align.
Follow you. Yeah.
They'll follow you. They will all row in the same direction. So that was really a tough, intangible quality, but it was consistent across all 9 of these individuals in the group. And then the other thing I would say across a lot of these folks they were all the type of person that could kind of parachute into a troubled operation and turn things around. They could kind of systematically push process and culture and ultimately make the organization a better organization.
So they didn't have to be subject matter experts in the space of that entity. They had to be all the other characteristics. They had to be good leaders, not necessarily subject matter experts.
That's right. Exactly. Exactly. And on this turnaround front, the person that comes to mind, as you mentioned, is Dave Cote. So Dave Cote was somebody I knew when he was CEO of TRW. And then when he showed up at Honeywell, Honeywell was a borderline dysfunctional organization. It was a product of 3 different mergers. They had Allied Signal and then legacy Honeywell. And then they'd recently acquired Pitway, the security products company. And so when he showed up, they had 3 different cultures, different operating systems, different ERP systems. It was a mess, right? And so he went in there and he systematically pushed through a common operating system. He established a one culture kind of theme throughout the company. And then he was actually an excellent capital allocator as well. And so after 10 years of Dave Cote, Honeywell was one of the best executing industrial companies in the entire industrial landscape.
And would you own a company today in your diversified portfolio where you didn't love the CEO, you didn't think they exhibited these types of characteristics? Would you own that company? Or if you didn't trust the leadership, regardless of the business proposition or their prospects, you wouldn't own it?
I wouldn't own it. Yeah, I think these are just lessons learned from decades of investing that you learn over and over again, and then ultimately you try to execute that on your portfolios.
So you generally manage a pretty concentrated portfolio, which works great in the capital system. We like to say in the capital system, with several different portfolio managers in a certain strategy and research analysts investing in that strategy, you're not left with one individual's 300th best idea. So for you, in your concentrated portfolio, is that 30 stocks that you'll hold, 100 stocks? How concentrated, and why is it so concentrated?
Yeah, so I try to hold 20 stocks or less across each of my responsibilities. And the reason is twofold. First of all, it's just math. If you hold a highly diversified 20 stock portfolio, the standard deviation is really actually not that much higher than, say, a 40 stock portfolio. So all else equal, I will have a higher level of conviction and a higher level of understanding across 20 stocks than 40 stocks. And so therefore, in a way, counterintuitively, I think it's actually a risk mitigation measure because I feel like I understand these companies better, and hopefully I understand the risks inherent in each of my holdings a lot better.
So that's the analyst in you wanting to be a subject matter expert in everything you own in some ways. Because if you're holding 20 stocks versus 200, you can really be an expert in those 20 stocks. In those, how much are quote unquote underwritten by the analyst and how much are underwritten by you in your own portfolio management capacity?
Yeah, well, as somebody who was an analyst for over 30 years, as you might imagine, I am a champion of our analysts.
Yes.
I understand and appreciate the work that they do, and I try to partner with them whenever I can and leverage the great work and intensity of research. So I would have to estimate that more than 90% of what I hold with our analysts.
Great. So in a concentrated portfolio, we're going to further concentrate 20 down to 1 or 2. And the caveat is you can't have any open orders on the trading desk right now. But what's 1 or 2 stocks that you own right now that you have super high conviction in, and why?
Yeah. Well, one stock I have super high conviction in today is a company called GE Aerospace, which of course is one of the 3 spinoffs from GE. And I've held it for a while, and there's a few things that I like about it. First of all, they are the largest manufacturer of commercial aircraft engines in the world. And the aviation and air travel industry has lots of runway for just natural growth. I mean, the reality is that 80% of the people in the world have actually never stepped foot on an airplane. And GE actually powers 3 out of every 4 commercial flights in the world. So they have a dominant
I didn't know
position
that.
in the industry. And then in addition to that, they have an exclusive supplier arrangement on the Boeing 737 and a leading share on the Airbus A320. And so those 2 jet families, if you will, are essentially the workhorses of the commercial air fleet, and they have high cycles and as a result generate a lot of aftermarket and service revenue, which is really the sweet spot of profitability for an aircraft manufacturing company. And then beyond that, there's a great management story there too. So we've got Larry Culp at the helm, who is one of my 9 CEOs
Right.
in my work.
Does Larry know that? Have you told him that?
I have. I've shared this conversation with him. And so he is somebody that I have the utmost of respect for. And he has an excellent team underneath him. And we've met all of those folks. And they have this program called Flight Deck, which is their lean management program where they drive through operational improvement on the factory and assembly operations. And essentially, they help to reduce cycle time and inventory and flow. And it has tremendous opportunity for more operational improvement there.
So I wish I knew that Larry's story before I saw him this summer. I could have given him a great shout out for how well you respect him in that regard. So that's a high conviction. And are you worried at all that business can be, even though the secular projections are super high and you have conviction in them, it can be a cyclical industry in terms of recessions and how that could impact the company? Do you think at all about that, or you just take a super long-term approach?
Yeah, I do think about that, and there's some sensitivity around economic cyclicality. But as somebody that followed industrial manufacturing companies for a long time, I always tell people there's a spectrum of cyclicality. So you can go towards one end and invest in deep capital goods companies, deeply cyclical capital goods companies, and those will cycle around different economic cycles, of course. But there are other companies that tend to be very resilient because of the high level of aftermarket revenue and recurring business in their portfolio, and that's GE Aerospace. A significant majority of their profits really come from this annuity type business around maintenance and aftermarket and service revenues. So I think it's a much more resilient business than what you mainly see across the industrial sector.
Okay, I'll give you a 2-minute break on the investment discussion to do the office treasure hunt, which I love.
Okay.
All right, so in your office, I took a few things, and as a reminder, we have folks who watch this and listen to it. So those who are listening, what we're putting up behind is a picture. You have a photo of 5 individuals, all look relatively young. And then I, in my hand, have 3 others that are very similar to it. So why are these photos in your office? And I'll give you the one that's also on the screen.
Okay.
Can you describe it and why it's important to you?
All right. So Mike, these are all my children. I had the great pleasure of serving as the investment lead for the TAP program, which we call the Associates Program. That was a program that existed at Capital Group for close to 35 years. It was actually the brainchild of John Lovelace, who is the son of our founder and is also the architect of a number of different signature programs here, including, of course, the capital system.
Mm-hmm.
But John's idea, as I understand it, was he wanted a rotational development program of young people that would ultimately yield future leaders for the organization. And to credit John's vision, at one time I looked up and I realized that almost half of the management committee were TAP alum.
Right.
So
it worked.
It worked. And so TAP was a program where these young people come in 2 years, different rotations, and then they get placed in different parts of the organization. We've since dismantled the program, as you know, and we have now a program called CAP, which stands for the Capital Associate Program. So we're not really very good at acronyms, obviously,
Right.
But it's the same concept.
It's the same concept.
Essentially, we're bringing young people out of undergraduate school. We're training them to be investors, and ultimately they go out and make a big impact on our firm and can have their entire career here at Capital Group. So it's been a wonderful program. The picture you see in front of you is actually from a nonprofit gala and a nonprofit that I was involved in, because I always felt like the giving back lesson was an important thing to introduce to these young tappers once they joined us, because it's something that certainly permeates the firm, as you know. So that's why you see these pictures on my wall.
And then the other 3 pictures, it's just subsequent years?
That's right.
Okay.
Exactly.
So these are your work children.
Yes, exactly.
Well, I know they appreciate your mentorship, And you having it on your wall speaks volumes to how important it is to you. And you were a huge help in that program for a long time, by the by. So thank you. Let's get into some lessons learned. You've been a super successful analyst, as Martin Romo had mentioned, an expert in industrials, but you got some things wrong over the years. Can you give us an example of something that didn't go the way you thought it should go and what you learned from that?
Yeah. Well, I was thinking about this question, Mike, and I can tell you, we could talk for a few hours on this particular subject.
Every investment professional I interview says the same thing. The list is long, but
yeah. But let me share one example with you because I think there's some good lessons. So I remember when I was a young analyst in Chicago, I followed, among other industries, the pulp and paper industry. We had a big investment in a company called Stone Container. Stone Container was a leading manufacturer of linerboard and boxes. And they had this habit at the bottom of every cycle of making acquisitions on the cheap, which of course would enhance their returns when we came out on the other side. The problem was this particular down cycle was prolonged in terms of its duration. And so as a result, an investment in a company with high leverage quickly became an investment in a company that was in imminent liquidity crisis. And so I moved from being an equity analyst to a high yield analyst because I was focused on really monitoring the cash balances and their capacity utilization on their revolving credit facility and looking at their inventory levels and asset sales. And so coming out on the other end, I think the investment was fine, although it was diluted a bit because they had to issue some convertible preferred securities near the bottom of the cycle. But the lessons from that experience were, one, it took a lot of time. It really took a lot of my capacity disproportionate to do other things. And secondly, it took up a lot of my emotional bandwidth. And so I came away from that experience with the notion that, there are a lot easier ways to make money for our clients. And so as a result, today, I look at myself as a generalist investor, and I'm just not that interested in companies with a lot of financial leverage, particularly if there's some cyclical undercurrent in their business.
Right. Yeah. Taking up that emotional and mental energy is dilutive to the rest of your time for other holdings. That makes sense. Your investment edge on the other side of the spectrum, everyone has a unique approach. We talked about you having a highly concentrated portfolio, being a deep dive analyst in everything you own. Is that your investment edge, or how would you describe your investment edge?
Yeah, well, this is not going to be novel, but my investment edge is really about being long-term. I was taught to be a long-term investor early on in my career, and I've carried that with me through the whole time. I have investments that I've held for 10 years plus, and essentially, as long as the thesis doesn't change and the valuation remains reasonable, from my standpoint, I feel like there's no reason to do anything else. And that's really worked out for me. So I feel like just being long-term and not duking it out over what's going on in the next quarter or the next 6 months has been my competitive advantage for a long time.
I want to shift towards the end here towards community. It's one of our 5 core values at Capital Group. And you are super interested and passionate about different communities that you help. Can you share a little bit about that?
Yeah, community is one of my favorite core values here at Capital. And I think there's a lot of layers to it. Like, first off, of course, internally, I think we have such a strong community and a strong culture and a culture around fairness and supporting our associates all over the world. And then, of course, community branches out to our partners on the distribution side and our suppliers and the great brand and reputation we have in the marketplace. And then community, I think, also manifests itself externally through our associates in a lot of the work that they do, particularly in the nonprofit community and how we support their efforts through our Capital Cares operation. And so for me, I've been involved in nonprofit activities for over 30 years now. My current passion is an organization called Thrive Scholars, which is, I would characterize, a college and career readiness program for high academic achieving, really deserving young people that come from low-income communities. And the centerpiece of our program is we have a 6-week intensive summer academy that we put our scholars through after their junior and senior year of high school, where they get a lot of math, a lot of reading comprehension to better prepare them for the college journey in front of them.
So they're about 17 years old.
Exactly.
Right.
Yeah. And the interesting thing is, before we had the summer academy, we had the same kids operating at a very high level when they were coming out of high school, but they would get into college and they would graduate at a 90% rate, but they'd have on average a 2.7 GPA. And if they majored in a STEM major, 75% of the time they'd change their major. And so our founder had the brilliance and forethought to understand that we needed to do something different to close the academic achievement gap. And so he created these summer academies. And now, post-summer academies, our kids graduate at a 98% rate. They have a 3.3 to 3.4 GPA, and they have almost a 70% STEM persistence rate, all metrics that are higher than the colleges they actually attend. And 40% of our scholars go to the Ivy Plus schools.
So that's in 6 weeks. In just 6 weeks in that intensive program, you can get that type of proficiency?
Well, 12 weeks to be
It's
fair.
12, okay.
Yeah, because they do it 2
Well,
summers.
still a short period
Yeah,
of
it's
time.
a short period of time. And it's amazing. It's transformational. We don't know of another program quite like it, but it's something that I'm very passionate about. And I think that I really appreciate the fact that the Capital Group is supportive of, what I do, and certainly all of our associates in their nonprofit endeavors along the way.
Well, you're not wrong. I won't get the stat exactly right, and hopefully this isn't edited out because I got it wrong. But about $400 million has been donated through our Capital Cares program and our associates over the last decade, which is just a tremendous amount of money to the community as a whole, and that's globally.
Yeah.
Let's finish up with a grateful moment. What are you obsessively grateful for? And I'm going to share with you the mug, the oversized, obsessively grateful mug that I'm grateful for you. I'll give this to you. I'm grateful for you joining us on the podcast. But Martin, what are you grateful for?
Yeah. Well, for me, it's simple. I mean, I love what I do, and I love the fact that it has such a positive impact on millions of people, and the fact that I get to work at a place that values culture and values that mission is a real gift.
Well, it's been a gift to have you on for this 35 minutes. It's a gift to have you at Capital Group. So thanks for everything you do for clients and also associates. You're a good mentor yourself, so we appreciate that. Thanks for joining us, and please subscribe to Capital Ideas on YouTube or wherever you get your podcasts. Have a great day.